Sandisk spent years being known for memory cards, USB drives, and consumer storage. Now AI is pushing the company into a completely different position. Its data center business has exploded, its revenue has surged, and management is now telling investors that this is not just a temporary memory cycle. Sandisk believes AI infrastructure could support mid to high teens annual revenue growth from fiscal 2028 through 2030, while adjusted gross margins remain around 80%. Investors reacted immediately, sending the stock more than 15% higher after the company presented that long-term outlook. The obvious question is why? Sandisk does not make GPUs. It does not train AI models. It does not operate hyperscale cloud platforms. Yet AI data centers are suddenly turning flash storage into one of the most valuable parts of the semiconductor supply chain. To understand the opportunity, imagine what happens after an AI model is trained. During inference, the system has to serve millions of user requests, retrieve enormous amounts of data, manage model parameters, store intermediate information, and feed processors fast enough that expensive GPUs are not sitting idle. Compute is only useful when data can reach it quickly enough. As AI models grow larger and inference workloads multiply, storage is becoming a bigger bottleneck. That is where Sandisk enters the story. In its latest fiscal fourth quarter, Sandisk reported revenue of $8.97 billion, up 51% sequentially. Its data center business has become its fastest-growing end market, and Reuters reported that data center revenue increased more than 400% in fiscal 2026 compared with the previous year. In the fourth quarter alone, data center revenue doubled from the previous quarter. This is not simply a case of Sandisk selling more SSDs. The economics of the entire NAND flash market have changed. AI infrastructure spending has tightened supply across high-performance memory and storage, while demand from hyperscalers has risen much faster than producers can expand capacity. Reuters reported that a global shortage of high-end memory chips has driven prices sharply higher, helping companies such as Sandisk generate extraordinary revenue and profit growth. Sandisk's own fourth quarter numbers show how powerful pricing has become. The company said roughly one-third of its sequential revenue growth came from higher shipment volumes, while about two-thirds came from higher pricing. That is an unusually important distinction. Selling more products creates growth, but selling the same products at much higher prices can transform profitability much faster. This helps explain why Sandisk's reported net income reached $6.9 billion in the quarter, compared with a loss a year earlier. Revenue rose from $1.9 billion a year earlier to almost $9 billion. The company also projected first quarter fiscal 2027 revenue between $10.3 billion and $10.8 billion. But the most interesting part of Sandisk's strategy is not the current shortage. Memory companies have experienced shortages before. Prices rise, manufacturers expand production, supply catches up, prices collapse, and the cycle begins again. Sandisk is trying to break that pattern. At its Investor Day, management described a new business model built around longer-term agreements with large customers. Sandisk has already signed agreements with 8 customers, including 3 U.S. hyperscalers. Those agreements are expected to cover roughly half of the company's storage output in fiscal 2027 and around two-thirds in fiscal 2028. This could change the economics of the company dramatically. Traditional memory manufacturing can be brutally cyclical because producers build factories without knowing exactly how much customers will eventually buy. If demand slows, manufacturers are left with too much capacity. Prices fall, margins disappear, and companies may be forced to cut production. Sandisk is trying to move toward a model where customers commit to future volumes before that capacity is fully produced. This does not eliminate the cycle, but it gives the company much better visibility. Think of it like the difference between building an apartment tower and hoping tenants arrive later versus signing long-term leases before construction is finished. That visibility matters even more because memory manufacturing is extremely capital intensive. Sandisk relies heavily on its manufacturing relationship with Kioxia, and expanding NAND capacity requires years of investment, complex fabrication equipment, and enormous fixed costs. The closer Sandisk can match future production with committed customer demand, the lower the risk that it floods the market with unwanted supply. This is one reason management is confident enough to publish a multi-year growth target. From fiscal 2028 through 2030, Sandisk expects revenue to grow at a mid to high teens % rate annually, roughly in line with growth in the amount of storage capacity it produces. It also expects adjusted gross margins around 80% during that period. An 80% gross margin sounds extraordinary for a memory company, and that is exactly why investors are paying attention. Historically, NAND manufacturers have often been treated like commodity producers. When supply exceeds demand, price can matter more than branding. Sandisk is trying to convince investors that AI, tighter supply discipline, better technology, and long-term customer contracts can make future earnings much more durable. But the strategy goes beyond conventional flash storage. Sandisk is also developing something called high bandwidth flash, or HBF. AI systems currently depend heavily on high bandwidth memory, known as HBM. HBM sits close to GPUs and delivers enormous bandwidth, but it is expensive and capacity is limited. As AI inference expands, companies increasingly need much larger pools of memory close to compute. Sandisk believes flash memory can fill part of that gap. Together with SK Hynix, Sandisk has been developing a standard for high bandwidth flash. The idea is to combine much more storage capacity than conventional HBM with far greater bandwidth than normal flash storage. Sandisk says HBF is designed specifically for AI inference workloads, where systems need both fast access and extremely large memory capacity. The company has already taped out its first HBF memory die and is working toward delivering initial samples to customers developing AI inference hardware next year. Reuters reported that HBF is intended to combine HBM-like speed characteristics with the much larger capacity available from flash memory. This could become strategically important because AI is moving from training toward inference. Training a giant model may require thousands of GPUs operating for weeks or months, but once the model exists, inference happens every time someone asks a chatbot a question, generates an image, searches a database, runs an AI agent, or uses an AI feature inside software. If billions of people and businesses begin using AI constantly, inference workloads could become larger than training workloads over time. And inference has different economics. A company serving millions of users cares intensely about cost per query. If each AI request requires too much expensive HBM, the service becomes difficult to scale profitably. A lower-cost memory layer with much larger capacity could become valuable, especially for applications where not every piece of data needs the absolute speed of HBM. Sandisk and SK Hynix are trying to make HBF a standard before that market fully develops. In August, the companies released the first HBF technical specification through the Open Compute project. Google and Tenstorrent also participated in the effort, helping validate the technology and create a common framework for future AI systems. This is a much bigger ambition than simply selling more SSDs. If HBF becomes widely adopted, Sandisk could move closer to the processor itself. Instead of storage sitting relatively far from compute, flash could become part of the memory hierarchy surrounding AI accelerators. That would potentially increase the strategic value of NAND technology. Sandisk and Kioxia are also improving the underlying flash itself. Earlier this month, they announced a new high-performance QLC 3D flash technology designed for AI and data-intensive applications. That matters because QLC flash stores more bits per memory cell, potentially increasing capacity and reducing cost per bit. The larger pattern is becoming clear. Sandisk is trying to position itself at 3 different levels of the AI infrastructure stack. First, it sells conventional flash storage into rapidly expanding data centers. Second, it is using long-term supply agreements to reduce the volatility that traditionally makes memory companies difficult to value. Third, it is developing new memory architectures that could move flash closer to AI processors themselves. That combination explains why the company's stock has risen so dramatically. Reuters said Sandisk shares had increased more than 6-fold this year by the time of its investor day, reflecting investor expectations that AI storage demand could remain strong for years rather than quarters. But this is also where the risk becomes obvious. Earlier this month, Sandisk reported exceptional earnings and still saw its stock drop sharply. The shares fell more than 13% after its quarterly forecast, even though projected revenue was above analysts' formal estimates. Investors had simply expected even more. That tells us how dangerous expectations have become. A company growing this quickly can still disappoint if the market has already priced in perfection. Memory pricing is another major risk. Sandisk's latest growth has benefited enormously from higher prices. But semiconductor shortages do not last forever. If competitors add too much supply, if AI investment slows, or if customers decide they have purchased enough storage, pricing could normalize quickly. This is why the new customer agreements matter so much. Sandisk is effectively trying to protect itself before the next down cycle arrives. There is also technical risk around HBF. The technology may sound compelling, but it has not yet become a mainstream replacement or complement to HBM. System designers would need to adopt it, suppliers would need to manufacture it reliably, and the economics would have to be attractive enough to justify redesigning AI hardware around a new memory layer. Sandisk's plans remain a forward-looking bet rather than a guaranteed future business. Still, the company's transformation shows how far the AI boom has spread. At first, the winners were obvious. NVIDIA sold the GPUs. Then hyperscalers built data centers. Memory manufacturers supplied HBM. Networking companies connected the machines. Power companies began building electricity infrastructure. Now even flash storage is moving toward the center of the story. AI systems do not only need faster processors, they need enormous amounts of data located close enough to those processors to keep them working efficiently. That turns storage capacity into infrastructure. And Sandisk is trying to use this moment to do something memory manufacturers have struggled to achieve for decades: convert a volatile commodity cycle into a more predictable, contract-driven growth business. The biggest question is no longer whether Sandisk is benefiting from AI. Its numbers already prove that. The real question is whether the company can make today's shortage permanent enough and its customer relationships strong enough to keep these economics alive after the memory cycle eventually turns. If it succeeds, the company once known primarily for SD cards and USB drives may end up becoming one of the most important memory suppliers behind the AI inference economy.